So IREN Ltd is one of the fastest rising stocks that people are searching for right now, and that's because they've had crazy returns over the past year. They are up 409% over the past year. And if you're wondering what this is, basically it is a company that started as a Bitcoin miner and then they transitioned to AI infrastructure and data center providing. So they traded near $53 to $55 lately, but they got as high as around $77 for like their all-time high, right around early November of last year. So to summarize what they've been doing over the past year, they actually have returned again over 400%, outpacing market benchmarks, shifting, of course, to what pretty much all companies are trying to shift to right now, which is AI and data centers. They have a strong 76% or so net profit margin. They have been down a little bit over the past 3 months. We'll get to that in a second, but a lot of analysts are still bullish on them. And they also just got a contract with Microsoft and significant GPU investments aiming to reduce the crypto miner discount in its valuation. And that deal with Microsoft was actually a $9.7 billion agreement to deploy AI cloud infrastructure. This was also back on the 3rd of November when IREN actually published this article, so you can see why they hit their all-time high of around $77 right after this agreement was made. So now that we have a general idea of what they've been up to, what they're doing, we can kind of dive into the numbers and some things I like and don't like about this before we draw a full conclusion. And before I get into this, obviously none of this is financial advice. Please do your own research. Everyone's portfolio is allocated differently and everybody has different goals. So over the past 6 months, they've also had up 230%. Again, a lot of these returns had a huge spike in November, but they've also been going up since December as well over the past couple of months. Now, over the past month, they're up 12.75%. Over the past 5 years, they don't seem to have enough time as a publicly traded company to have a full 5 years, but they are up 119% from where they started when they first went public, which is still really solid. Now, comparing that to the S&P 500, you're looking at definitely outpacing them over the past year, over the past 5 years, and over the past 6 months. If you look over the past 3 months, that's a little bit of a different story. They're actually down 25.56% over the past 3 months. Some other things to keep in mind, their PE ratio is a 30.9, which isn't too crazy considering what they're doing. If you look at a lot of AI and other stocks related to what they're doing, like with data centers, they are actually much higher than this. But of course, they justify it based on their returns. If you look at their quarterly financials here, they look really good. As you can see, revenue up 355% year over year, and their profit margin looks pretty good. Earnings, obviously, they missed September 2025. That was also before they got that big deal with Microsoft announced, so maybe that will impact things going forward. They did miss also March 2025, but they had a nice quarter at the end of December in 2024. So now if we look at a little bit more of a deep dive in their Google Finance page here, a few things I wanted to point out. So if you look at their total assets versus liabilities, that's a pretty good sign there. They are about a 3-to-1 ratio on assets versus liabilities. If you look at their return on assets and return on capital, not quite what you would like to see, of course, being negative. That usually means they are not profitable, at least for that particular quarter. So we'd like to see that improve, of course, but that was back in September 2025. So we'll see how this looks. I have a feeling that their next quarter is going to look really good on their next report. Now, the price to earnings ratio, again, is a little bit different the way it's calculated on Robinhood versus Google Finance. So I like to look at both of them to see if there's much of a difference. They do have a 26.93 price to earnings ratio on Robinhood. So neither of them, I would say, is a red flag. And again, you don't have a dividend yield, so you need really high growth from this type of stock. Now, as far as what customers are doing lately, they are buying. If you look at hedge funds, it's a little bit up and down. You see hedge funds decreasing their ownership in Q3 2025 by 1.3 million shares versus Q2. Again, that might have been before that big deal got announced with Microsoft, so that might change drastically in the next report. But Q3 2025, 93% sell, 7% buy, 81% buy, 19% sell in Q2 2025. As far as what insiders are doing here, they don't have much going on. Again, this is just something you would even take with a grain of salt anyway. But as far as what analysts are saying, I think this is a little bit more telling. 15 Wall Street analysts are saying an 80% buy score, which is really solid. Hold 13.3%, and then sell 6.7%. So really good scores here from 15 analysts. 15 is actually not that many compared to a lot of the more mainstream stocks that people would talk about more regularly, but it is still, a fair amount of analysts that are mostly agreeing it is still a buy, despite them having a pretty rough last 3 quarters. But again, they hit a new all-time high after a big announcement of a multi-billion-dollar deal with Microsoft. So in a way that makes sense that a lot of people would be taking some profits after that, and then maybe it would work its way back up from there, which seems to be what it's doing. Now, if you actually look at their earnings here, a little bit of a different story. They seem to have a little more information on Robinhood right now, but if you look at Q4 2025, they beat by quite a bit. Q1 2026 looks like a major beat right here. Assuming this is all accurate, that's a great sign. Now, if you look at the PEG ratio, this is another alternative to the PE ratio that a lot of them would use. They actually have a 0, which is usually not the greatest sign because that usually means not profitable. So there's some things here where you're talking about like forecast PE growth rates being negative 2,600, things like that. PE ratios 2026 negative 70. So some of these things are a little bit of I don't know if I'd say a red flag, but at least a yellow flag, because you want them obviously to be profitable. And when you see a 0 here, that's usually not a great sign. Return on assets, things like that being negative, also not usually the best sign, even if the other numbers look pretty good. Now, if we look at the EV to EBITDA ratio here, they do have a 17.81, which doesn't seem too crazy, but it is apparently ranked worse than 69.94% of 529 companies in the capital markets industry. Now, I normally like to go and see what their employees are saying about them to get an idea of, are they a well-run organization? Do they have good leadership, etc.? I literally can't even find a working Glassdoor page for this company. So it's hard for me to even give you an idea of whether or not I think they might have good leadership. If you find other companies under a similar name, a lot of them are in like India or in other locations, and they're not the right one. They are actually based in Australia. Now, they did have a strong strategic pivot, which actually led to historical returns. The deal with Microsoft really helped with that. It looks like their stock is climbing despite it going down after a little while. When they had that deal, they reached an all-time high. As you can see, they had a bit of a dip here after that happened. After around mid-November, their stock went back down to in the mid-30s or so. Well, it's climbed all the way back up to around the low 60s and mid-50s, in that range, over the past month or so. So maybe they didn't require just some big deal to have a big spike, and maybe they will work their way back up to a new all-time high. All in all, I think this could be a buy if you are someone who actually doesn't already have a ton of stock in AI or infrastructure for AI in your portfolio already. If you're not too tech heavy already, maybe you might want to look into this one. They haven't even been public for 5 years yet. They may have some more strong growth going forward. They just had a big deal with one of the biggest companies in the world, with Microsoft. So there are some good signs here. Maybe their leadership is good because they made a strategic pivot away from Bitcoin mining and towards AI and AI infrastructure with data centers. That might be a good sign as well, that maybe they could get some more deals going forward. Maybe they are, in fact, riding that wave and are positioned very well. They're doing something right to get a multi-billion-dollar deal from Microsoft, obviously. But to me, if you already had, blue chip tech stocks or AI stocks like Google or Nvidia, like I do, I'm not really looking to add more into that position because I don't know that I really want to sell any of those yet and take profits on those. They've done so well. I don't see them going anywhere right now. And so IREN is just, unfortunately for my situation, they're just another one in the AI and tech stock category. And so I probably won't be buying them right now. I will probably keep an eye on them just to see how they're doing. But again, I have enough in this same category already for my portfolio. That doesn't mean you do. In your situation, maybe it makes sense. Maybe you could use a little bit more allocated into high growth, maybe a little bit higher risk as well. Because I do think this is a little bit more of a higher risk. Again, they had a pivot. The pivot seems to be working, but they have some indicators that say maybe they aren't as profitable as they should be right now. Their ROA and their ROC were negative. They have a 0 for their forward PEG right now. So there are a few things where you're like, well, I don't, not all signs seem to be looking exactly where I'd like to see them. Again, I can't even find employee reviews for a publicly traded company. That's very weird. Not any of these indicators by themselves are really a huge red flag and would make me decide one way or the other just by themselves. But you have to look at the accumulation of all the signals you're getting here. So to me, it's a buy if maybe you don't have a lot of tech already, or you don't have blue chips already and you want something with really high growth potential, and you're looking for something that capitalizes on AI and data centers with the backing of a major company like Microsoft. Again, I think this one could be higher risk than something like Google or maybe even Microsoft super long term, or something like Nvidia, just because it's a little bit of an unknown. They haven't been public very long. There's a lot of information I'm not really able to find about them right now. So I would put them a tier below the some of the top AI and data center stocks that I've already mentioned. None of this is financial advice, of course. Everyone's situation is different. Whether you should buy, hold, or sell is going to depend a lot on your risk tolerance, your portfolio allocation, and when you are looking to eventually take profits.